Well, the banking crisis in the past few weeks has been unusual, and that's because most bank crises happen because businesses go broke, leaving the banks and other lenders with bad debts. Not this time, though. It happened because some banks bought the wrong long-dated securities, leading to losses as interest rates rose. But the cycle of high interest rates is not yet over, and the worry about where the stresses will next pop up could cause another problem, a lack of confidence, so a lack of liquidity in the banking industry. And that was one of the trigger points for the global financial crisis back in 2008. Andrew Kenobi is the director of the Franklin Templeton Fixed Income team in Australia, and he joins me now. Many thanks for your time on the program, Andrew. Just explain this problem of liquidity if there is a crisis in the banking industry.
Thanks very much, Ross. So in the United States, we've seen a couple of high-profile banks fail in recent weeks. And this has a number of issues really that lie behind it. So yes, there's some risk management idiosyncrasies in terms of the way some of those institutions manage their asset side versus their liability side. But I think what we're seeing is symptomatic of a general tightening in credit market conditions. And that's flowing through the economy, and it's exposing some of the vulnerabilities in terms of business models and seeing a desire for more liquidity in the economy, which of course is flowing through to the banks themselves. So, we're not of the view that necessarily this is a similar type of crisis to what we saw in 2008, 2009, but certainly it's not surprising that when you've had the most aggressive tightening cycle from the US Federal Reserve in history in a very short period of time, you are going to see some weaknesses exposed, and that's really what we've seen in the last few weeks.
OK, so one issue about liquidity is immediately that these banks started to get into trouble, be it Silicon Valley Bank or Signature Bank or even Credit Suisse, you've seen central banks come out with a lot more liquidity. In the case of Credit Suisse, for example, the Swiss Central Bank came out with $100 billion worth of support for the new UBS merged business. So is this a response? But the problem, as you point out, is that potentially is inflationary.
Well, so central banks have to really plug that gap when consumers or counterparties to the banking system lose confidence. And so certainly in the case of UBS and Credit Suisse, you had a very rapid demise of an institution as confidence really was lost from the community about that particular bank. In the United States, you saw that confidence lost in terms of a very rapid withdrawal of deposits from some of those entities, and of course that had to be plugged, if you will, by the Federal Reserve, creating additional short-term facilities, medium-term facilities as well, to help banks access liquidity. So I think central banks have the tools and they're deploying them quickly, and this is again probably not the last time we see some of these measures brought out into the marketplace as we go through this very, very significant period of monetary tightening, but they do stand there ready to act quickly as needed.
Yeah, one of the interesting parts about this, and you make this observation about the New York Federal Reserve's Senior Loan Officer Survey, which says that signal conditions as tight as currently indicated in the United States has soon entered a recession, the US economy. Now, that's also what the inverse yield curve for a long time had really been pointing to in the United States. And that was all about tighter monetary conditions, as you point out.
Yeah, that Senior Loan Officers Survey is quite significant. It's quite widely followed and accepted as a very good bellwether for credit conditions across the US system. There are thousands of banks, of course, in the United States, and many of those smaller mid-size institutions are responsible for a large amount of commercial and industrial lending, including to areas like commercial property. And so that survey captures their sentiment. The most recent one we had is at the end of Q4, where, as you point out, Ross, it was already pointing towards quite tighter lending standards and conditions. And that, of course, precedes all of the ructions we've seen in recent weeks. So our expectation is that the next one that comes out is going to be even tighter still. And of course, when you slow the flow of credit to an economy that's quite financialised and relies on access to debt capital as quickly as that, then the logical risks are, to our mind, that recession is certainly a higher probability. And on the yield curve, which has been inverse, so in other words, those short-term yields have been quite a lot higher than medium to long-term yields. That's a very, very significant indicator. It's got a very long track record over many, many years at forecasting a recession, because it's the bond market's way of saying that policy has done enough. It's actually moved quite quickly to push those short-end yields higher, but on a medium-term basis, there is going to have to be cuts coming through at some point to respond to a downturn.
So one other aspect of this, as you know, when the banking crisis this time took off, you know, SVB went, Signature went, Credit Suisse went, then there was a wobble at Deutsche Bank, which seemed to be then reassured by the European Central Bank. But then in the meantime, First Republic in the United States, that was, merged, forcibly merged. It's almost like you're trying to guess where the next one will pop up. Do you think that guessing game is yet over, or is that yet another phase of what might happen as a result of this tighter liquidity?
So our observation is that those tight liquidity conditions are still in place. It may be that we see more institutions come under pressure. The Federal Reserve, by putting in place some of the facilities they have, has probably alleviated some of the near-term risks. But I think at the time they're reminded that banks run on confidence. And of course, as soon as that confidence goes, their ability to do business, which they need to do every single day, becomes impaired, and they can very quickly lose access to markets. They can lose deposits in the case of something like SVB Bank, and then it's game over. So, and the other issue, of course, that the banks have is that they're competing for deposits in a high interest rate world, and customers can access high interest rates in the money market through cash management funds, through treasury bills themselves. And so their cost of funding has gone up enormously. And the consequence of what's happened in the US and what's happened in US, rumours around Deutsche Bank as well, generally seeing this cost of capital in bond markets for banks has been moving higher. And so that's another headwind as well.
And yet, the central banks can't do much about this while they're actually trying to fight inflation. So they can't have it both ways in some ways, because that's ultimately what higher interest rates are all about.
That's exactly right. And to our mind, what are central banks trying to do? Well, they're trying to make the price of money more expensive, and they're trying to slow the creation of credit in the economy. And so you could observe that these events are, in a sense, consistent with what they've been trying to do. They don't want to see institutions fail or a loss of confidence in the financial system, but this is a natural outworking, to our mind, of what central banks are trying to do in create a tighter lending environment. So, in the one hand, taking with the left hand and giving back on the right hand through balance sheet management. Let's not necessarily call it quantitative easing, but effectively injecting liquidity through other measures whilst they're raising interest rates. That only goes so far. The markets are very much entertaining the view that we are fairly close to the end of this tightening cycle. And so I think the likelihood that they're raising interest rates and at the same time easing liquidity through other measures for an extended period is probably pretty low.
Yeah, Andrew Kenobi, the head of fixed interest at Franklin Templeton here in Australia. Many thanks for your time on the program today.
Thanks very much, Ross.